Welcome to Talk Tickers. We are your premium earnings call summarization deep dive for experienced investors. Today, we have a really fascinating one.
Yeah, we really do. It's quite the paradox.
Exactly.
Yeah.
We're looking at UiPath,
Yes.
chicken symbol path, specifically their Q4 and full year fiscal 2026 results.
Right. And you really have to look under the hood for this one because the surface level reaction is just wild.
It makes no sense on paper.
Yeah.
I mean, imagine you own a business,
Yeah.
right? And you just posted your first ever full year of pure GAAP profitability.
A huge milestone for any software company.
Huge. And your operating margins are expanding. You hit like 31% in your latest quarter.
Yeah.
Plus, you've got over $1.5 billion in cash sitting on your balance sheet.
With zero debt, by the way. Zero.
Right, zero debt. You just finished a $1 billion stock buyback. You authorized another $500 million. You report these pristine numbers, and the next
The
morning...
market absolutely tanks your valuation.
Right. Yeah. They slash it by over 8%. You're down on nearly 3 times your normal trading volume, closing down at $11.37.
It's brutal. And if you're holding this stock or if you're just, trying to understand how the market values enterprise software right now in this whole AI boom, this is the puzzle you have to solve.
So that's our mission for this deep dive. We are going to unpack this disconnect. What breaks in the translation between a flawless balance sheet and a collapsing stock price?
Well, the divergence between the current reality of their income statement and what the market expects for the future, it's rarely been this wide.
Yeah.
Because you have a company here that has totally transformed its cost structure. They prove they can generate real, durable cash flow.
Right. They aren't just burning cash anymore.
Exactly. But the problem is the enterprise software sector. Investors have this insatiable appetite for top-line revenue growth.
Especially if you attach the letters A and I to your company name.
Oh, 100%. The moment you say AI, they expect hyper-growth. So the market is looking at this earnings print and asking a very binary question.
Which is?
Are you a highly profitable, mature company just, harvesting your existing install base? Or are you a growth compounder that's just taking a quick breather before a massive AI-driven reacceleration?
And the numbers that triggered this whole identity crisis require a really close look. Because like I said, on the surface, they're executing flawlessly.
Let's run through that Q4 beat.
Yeah, so revenue hit $481.1 million. That's up 14% year over year.
And it comfortably cleared the consensus. I think the street wanted $464.8 million.
Right, and if you back out the currency fluctuations, like normalize for an FX tailwind of roughly $16 million revenue, still grew a very solid 10%.
Double-digit growth at that scale is, it's nothing to scoff at.
No, not at all.
And the bottom line performance is where it gets really interesting. Non-GAAP diluted earnings per share came in at 30 cents.
Which beat the 25-cent consensus.
Yeah, a 20% beat on the bottom line. But the truly significant metric, the one that actually alters the fundamental DNA of the company.
The GAAP EPS.
Yes. GAAP diluted EPS came in at 19 cents. Actual, unadjusted, generally accepted accounting principles profit.
Which, for anyone who's tracked the automation and RPA, space robotic process automation, for the last 5 years, that is a monumental shift.
It really is. The persistent bear case against this whole cohort of software vendors was always that they were just buying revenue.
Right. The critique was always, they spend so heavily on sales and marketing and stock-based comp that they're never going to actually make a real GAAP profit.
Exactly. So delivering 19 cents of GAAP EPS in a single quarter and getting their first full year of GAAP profitability, it completely shatters that legacy narrative.
It absolutely forces the market to value them differently. You can't just dismiss them as a cash-burning growth experiment anymore.
Yeah. No, you really can't. And if you look at the core health metric, the ARR, annualized renewal run rate, it hit $1.83 billion.
Up 11% year over year.
Right. They brought in $70 million of net new ARR just in Q4. Even backing out a slight FX tailwind of about $14 million, it just shows really steady compounding growth.
It's an incredibly sticky recurring revenue base.
Okay.
So you hear those numbers, right? Top line beat, massive bottom line beat, solid ARR growth, historic GAAP profitability.
You'd expect a massive pop.
Exactly. By all traditional value investing logic, they knocked it out of the park. The stock should have soared. But because this report was after hours, the reaction happened the next day.
Yeah, it was ugly.
It fell from $12.38 down to $11.37, a drop of 0.16%.
And the volume was the really crazy part.
Oh, the volume tells a story of genuine institutional capitulation. Roughly 91.4 million shares traded the day after the print.
And the average daily volume is what, like 32 million?
32.25 million?
Yeah, so nearly 3 times the normal volume. That is not retail investors taking profits.
No way.
That volume signature means large funds, institutional holders, they were aggressively dumping the stock and repositioning.
And this is where it gets fascinating. There is a glaring anomaly in the market data that totally contradicts that equity sell-off.
The options activity.
Yes. The equity holders were hitting the bid, driving the price down. But look at the derivatives market on that exact same day. There was this unprecedented surge.
Massive call skew, right?
Massive. 184,162 call contracts traded, compared to only 74,441 put contracts.
That's a put-to-call volume ratio of 0.40.
Which is an extreme outlier. Why are options traders aggressively betting on upside buying calls on a day the stock is cratering 8%?
Well, the options market is basically signaling that all the bad news is now fully priced in. They're looking at the underlying cash generation and saying, hey, this provides a concrete valuation floor. They are looking way past the headline panic.
Because the equity market wasn't really reacting to the Q4 numbers we just talked about, were they?
Not at all. Q4 is backward-looking. The institutions were doing a classic sell the guide reaction.
Right. It was all about the forward-looking guidance for fiscal year 2027. That's the catalyst.
Yeah. Management laid out their expectations, and that is exactly where the growth premium vanished.
Let's break down that guide. For Q1 of fiscal 27, they guided for revenue between $395 million and $400 million.
With ARR between $1.894 billion and $1.89 billion.
And non-GAAP operating income of roughly $80 million. But the real damage, the true multiple killer, was the full year guide.
Yeah, that full year fiscal 27 guide was rough. Revenue projected between $1.54 billion and $1.759 billion.
So if you do the math on that,
take the midpoint, right? $1.756 billion. Compare that to the fiscal 26 actual revenue of $1.611 billion.
You get an implied forward growth rate of roughly 9%.
And there it is, 9%. In the software as a service sector, crossing that threshold from double-digit growth down into single-digit growth,
it's an executioner for your valuation multiple.
It absolutely is.
Yeah.
I mean, is that violent drop just algorithmic selling, or is it a genuine reflection of a deteriorating business?
It feels heavily algorithmic. It's about how institutional capital categorizes these companies.
Right. Growth rates act like a rigid step function for these funds. If a SaaS company is growing at 20%, it gets a premium multiple. Capital flows in freely.
Because the terminal value of those future cash flows looks massive.
Exactly. If it's in the mid-teens, it's viewed as a mature, reliable compounder. But the absolute second that top-line growth slips below 10%.
The algorithms and the quantitative models just recategorize the company.
They kick it out of the growth software bucket and drop it into the value software or legacy tech bucket.
And that triggers an automatic mechanical compression of the valuation multiple. It doesn't even matter how profitable the company actually is at that point.
Right. The funds that are mandated to hold high-growth software are forced to sell. That explains the 90 million shares of volume.
They aren't selling because the company is failing. They're selling because it doesn't fit the mathematical parameters of their specific mandate anymore.
Exactly. But if you're holding this stock, you're looking at that 9% guide and sweating, wondering if the growth story is permanently broken.
But there's a massive silver lining here that the market is just completely ignoring in its panic.
The profitability story.
Yes. Management really emphasized this. Fiscal 26 was their first full year of GAAP profitability in company history. $57 million in GAAP operating income for the year.
And in Q4 alone, their second consecutive quarter of GAAP operating income at $80 million.
And the non-GAAP numbers show even more operational leverage. Full-year non-GAAP operating income was $370 million.
Which is a 23% margin. That's over 600 basis points of margin expansion year over year.
Right. Adding 600 basis points of margin when you're at a $1.6 billion revenue scale, that is incredibly difficult to do.
It requires ruthless cost discipline. And remember, when they went public, They gave Wall Street a long-term model targeting non-GAAP operating margins of around 20%.
And they just blew right past that, hitting 23%.
Yeah, and on this call, management officially raised that long-term target to 30%.
30%. They're planting a flag in the ground, basically telling the market, we are just going to be marginally profitable. We're targeting 30 cents of operating income for every single dollar of revenue.
And we really need to look at how they are achieving this on a GAAP basis because it speaks to the quality of the earnings.
You're talking about the stock-based compensation.
Exactly. SBC is the dirty little secret of the sauce industry. Companies pay their engineers in stock instead of cash.
Which artificially inflates free cash flow while silently diluting the shareholders. It ruins DAP metrics.
Right. But UiPath's numbers show their stock-based comp dropped from 25% of revenue last year down to 18% this year.
That's a huge drop. They're actually rationalizing how they pay their employees, moving away from handing out equity like candy just to subsidize operating expenses.
It's a critical maturation point. It proved the business model actually functions without life support from the equity markets.
Think about the unit economics of a software company like building a massive state-of-the-art toll road.
Okay, I like this. Go on.
During the initial phase, the capital expenditure is just astronomical. You're blasting through mountains, pouring millions of tons of asphalt, building the toll booths.
You're burning cash at a terrifying rate. Margins are super negative.
Exactly. That's the hypergrowth phase. Heavy R&D, massive customer acquisition costs. But once the road is built, once the software is deployed across the enterprise, the physics of the business completely change.
Because the cost to maintain the road is negligible compared to the revenue?
Right. Every new car that drives through the toll booth, or every new automated process a customer adds, drops almost entirely to the bottom line as pure profit.
So you're saying UiPath has finished blasting through the mountain?
The road is built. They are transitioning into the phase where they just sit back and collect the tolls at incredibly high margins.
That toll road analogy perfectly captures it. The friction we're seeing in the stock price is just because Wall Street growth investors, they prefer to invest in the companies that are still actively blasting through the mountains.
They want that narrative of infinite expansion.
Yeah, but a company in the toll collection phase manages its capital entirely differently, which brings us perfectly to their capital allocation strategy.
Let's talk about what they are doing with all this newly generated toll road cash. They just finished a massive $1 billion share repurchase program.
$1 billion?
Yeah. During the fourth quarter alone, they bought back 780,000 shares at an average price of $12.83.
And for the full fiscal year, what was it?
30.9 million shares repurchased at an average of $10.92.
Wow.
And then from the end of January through early March, they aggressively bought another 14 million shares at $12.11 to finish the program.
And they didn't even stop there.
No. Following the completion, the board immediately authorized a brand new $500 million share repurchase program.
Which is where the debate gets incredibly polarized among investors.
Yeah, because management's stance is, look, this aggressive buyback reflects our ultimate confidence in the durability of our cash flows.
I mean, they generated $182 million in adjusted free cash flow just in this quarter alone.
So they're broadcasting, our stock is fundamentally mispriced. We have so much excess cash, we can fund our operations, invest in R&D, and retire a massive portion of our float all at the same time.
And there is a big, but here, take the bear case for a moment.
Okay, let's hear it.
If you are a high-margin software company operating right in the middle of the greatest technological arms race in history, the AI revolution is authorizing another $500 million buyback actually a signal of strength? Or is it a white flag?
That's the billion-dollar question.
Yeah.
Because typically, if a software company sees a massive total addressable market in front of them, they pour every spare cent into capturing that market share.
They hire more sales reps, they acquire smaller tech companies, they pump up R&D, they do not buy back their own stock at $12.
So the bears are asking, are you essentially admitting that you can't find high-growth internal avenues to deploy that capital?
Exactly. The bears pair that buyback with the 9% forward revenue guidance and say, you're buying back shares because you don't know how to organically accelerate the business.
It kind of solidifies the narrative that it's no longer a hyper-growth story. It's a cash-generating value play.
But management would vehemently argue against the idea that they aren't investing in growth.
Oh, absolutely. They point directly to their massive technological pivot toward AI.
Which brings us to the absolute core of the debate surrounding this company, the agentic thesis and the fears of AI cannibalization.
Right. If you want to understand the market's hesitation, you have to understand the existential fear surrounding traditional RPA robotic process automation.
Yeah, the foundational fear suppressing the valuation is this idea that generative AI is just going to render RPA completely obsolete.
Because traditional RPA is highly deterministic.
Right.
It relies on strict rules-based programming. If A happens, do B.
Right. It requires developers to explicitly map out every single step, like literally screen scraping data from a PDF invoice and pasting it into an Excel cell.
And the fear is that as large language models and AI agents get more sophisticated, they won't need those rigid rules.
Exactly. You just give an AI agent a goal, like process these invoices, and the agent figures out the intermediate steps on its own. It reasons dynamically.
So if the AI can do that, the bear thesis says you don't need this complex, expensive RPA platform that UiPath built its whole empire on.
But management is arguing the exact opposite reality. They claim AI doesn't cannibalize deterministic automation. It acts as a massive accelerant for it.
Yeah, the founder, Daniel Dines, had a really profound statement on the call. He said, when building becomes cheaper, more gets built.
The logic there is sound. Historically, the main bottleneck to automation hasn't been a lack of desire from companies. It's been the cost and complexity of actually developing the automations.
Exactly. If generative AI drastically lowers that barrier and suddenly non-technical business users can generate agents to automate their own workflows, the total volume of automated tasks is going to explode.
It'll go through the roof.
Let's put a concrete mechanism to this agentic automation concept so it doesn't just sound like abstract tech jargon.
Okay, let's ground it.
Think of the enterprise environment as the sky above a major city, and think of AI agents as airplanes.
Okay.
Generative AI is basically making it incredibly cheap, fast, and easy to build airplanes. So suddenly, every department in a Fortune 500 company, HR, finance, supply chain, they're all building their own fleet of AI airplanes to handle their tasks.
So the sky gets absolutely crowded with thousands of autonomous flights zooming around everywhere.
Exactly. Now, if the sky is swarming with all these new autonomous planes, do you suddenly need fewer air traffic controllers?
Huh? No, you need way more. The risk of catastrophic collisions becomes exponential.
Bingo. You need an enterprise-grade, massive air traffic control system more than ever. You need a centralized platform to manage the flight paths.
To make sure an HR agent doesn't accidentally pull restricted payroll data, or a finance agent doesn't execute a rogue wire transfer.
Right. You have to keep the planes from crashing and ensure they land safely. Deterministic automation, the strict RPA, is the precision of the runway. It's auditable, secure, governed.
And agentic automation, the AI, is the adaptability of the airplane itself.
Exactly. And management's thesis is that most software vendors are only offering one or the other. You either buy a rigid runway or you buy a wild airplane.
But UiPath is arguing they're the only platform purpose-built to integrate both under a single, unified control plane.
And that air traffic control mechanism is precisely what enterprise chief information officers are terrified about right now.
Oh, they are losing sleep over shadow AI. Employees using unapproved AI tools that hallucinate or leak proprietary data to the public.
Yes, and the data UiPath presented strongly suggests their biggest customers are buying into this control plane thesis. The adoption metrics are the definitive bull case for the stock.
Let's look at those metrics. Their AI product, ARR, reached nearly $200 million this quarter.
That is not immaterial revenue. We aren't just talking about small pilot programs in a sandbox.
No, 16 of their top 20 largest deals in the quarter included AI products.
And the penetration rates at the high end are wild. Among their elite cohort customers, generating more than $1 million in ARR, an astounding 90% are actively using their AI products.
90%. When 90% of your multi-million-dollar accounts are adopting a new tech stack, it has moved way beyond hype. It's core operational reliance.
And if you drop down one tier to customers with more than $100,000 in ARR, roughly 60% are using AI products.
And here's the kicker. The customers who buy AI products are spending nearly 3 times as much as those who do not.
Plus, that specific cohort of over 100K ARR customers that bought AI products, that cohort grew by 25% year over year.
The land and expand motion is working flawlessly when AI is attached to the deal.
The enterprises are clearly buying it, but we need to define what they're actually buying. How does the technology execute this air traffic control?
This brings us to their core product innovation, Maestro.
Maestro, the literal control tower in the analogy.
Right. It's their orchestration layer, and it's built on a highly regarded modern workflow technology called Temporal.
So for the listener trying to understand the tech stack, what exactly is Temporal, and why is it so crucial for enterprise AI?
Yeah, so Temporal is an open source framework famous for something called durable execution.
Durable execution.
Yes. In a traditional software workflow, if a server crashes or a network connection drops midway through a complex multi-day process, the whole system fails.
You lose all your progress and have to start over.
Exactly. But Temporal ensures that the state of the workflow is constantly saved. If the system crashes, it remembers exactly where it was and picks up right where it left off.
Oh, that's incredibly important.
It is. By building Maestro on top of Temporal, UiPath allows different types of automation to work together durably. It brings together agentic automation like open source AI agents built on frameworks such as LangGraph with deterministic RPA bots and human workers, all under a single governed umbrella.
Explain LangGraph briefly, because that's another critical piece here. How does an agent built on LangGraph differ from, just asking ChatGPT to do something?
A standard large language model interaction like a ChatGPT prompt is stateless. It answers your question, and then it effectively forgets the interaction.
Right. It doesn't remember the context.
Right. But LangGraph is a framework that allows developers to build AI agents that maintain state and memory across a complex enterprise task.
So they can loop.
Exactly. It allows an AI to loop through reasoning steps, consult an external corporate database, realize it made an error, correct itself, and then execute an action.
And Maestro takes these highly capable looping LangGraph agents and basically puts a leash on them.
It dictates what systems they're allowed to touch and provides a strict audit trail of every single decision the agent made.
Which is vital for enterprise adoption.
Yeah.
You simply cannot have a rogue, hallucinating AI agent executing financial trades or processing healthcare claims without a human-in-the-loop safeguard or a perfect audit trail. It's just too risky.
Totally. And beyond orchestration, they also highlighted upcoming product innovations, specifically coding agents or autopilot features.
Right, designed to tackle that primary bottleneck we discussed, the massive automation backlog.
Customers have hundreds of inefficient processes they want to automate, but they lack the highly paid developer resources to actually write the code.
But management noted these new AI coding agents will generate, test, and maintain production-grade automations in hours instead of weeks.
The reduction in time to value is just staggering. And they provided some incredibly concrete case studies on the call to back this up. Real-world dollars and cents.
Let's look at those. They highlighted a major telecommunications company in New Zealand. This telco had an order-to-cash process that was taking 4 to 5 days to complete.
And an order-to-cash process is the lifeblood of any B2B business. It's the whole life cycle. Signing a, quote, order entry, checking inventory, provisioning the service, invoicing, and collecting payment.
Right, and it historically takes 5 days because humans have to manually move data between the CRM, the billing system, the provisioning software, constantly checking for errors.
But this telco went from a proof of concept to a fully production-grade pilot in just 5 weeks using these new agentic tools.
The AI agents navigated those disparate systems autonomously. They reduced a massive 4 to 5 day manual process down to 10 minutes.
From roughly 100 hours down to 10 minutes, the velocity of the business just accelerates exponentially.
And the financial impact is insane. The telco is expecting roughly $20 million in pure cost savings this year alone, just from scaling this one specific automation.
20 million dropping straight to the bottom line.
And perhaps even more telling from a competitive standpoint was the example of a major U.S. semiconductor company.
Oh, this one was fascinating. This company had spent over a year trying and failing to deploy a complex agentic workflow using a rival software vendor.
A whole year with a rival and nothing to show for it.
Right. They finally abandoned the rival, brought in the UiPath platform, and were completely successful in under 2 weeks.
2 weeks?
Yeah. And that rapid success led to a massive 7-figure contract expansion across Agent Builder, Maestro, and Test Cloud.
That semiconductor company is now running over 3,000 distinct automations and has saved more than 2 million hours of manual labor.
2 million hours saved. I mean, when you hear concrete case studies like that, saving a telco $20 million, saving 2 million hours after a rival failed.
The 9% forward growth guidance almost defies logic.
It really does.
If the product is that transformative and the ROI is that immediate and massive, Why isn't top-line revenue growing at 30%? Why aren't CIOs just handing over blank checks?
That is the central, agonizing disconnect we're dissecting today. The narrative of hyper-adoption simply isn't matching the financial velocity of the guidance.
Right, because saving a telco $20 million sounds like an easy sell, but enterprise software isn't bought on a website with a credit card.
To understand why it's not instantly translating to 30% revenue growth, you have to look at how they sell, who they partner with, and the macroeconomic environment dictating those budgets.
Which brings us directly to their go-to-market strategy, the ecosystem, and the macro context. Having a world-class product is only half the battle. Your distribution channels dictate your actual growth.
Let's start with their verticalization strategy. For a long time, RPA was sold primarily as a horizontal tool. Buy our software, automate anything in any department.
But horizontal tools eventually face commoditization. Now, they are transitioning to deep, industry-specific, vertical solutions.
A prime example is the WorkFusion acquisition, which closed on February 6th.
And we really need to clarify some market rumors regarding the mechanics of this deal. There were reports in the financial press that WorkFusion was bringing in roughly $25 million in AR.
Yeah, if that were true, it would have artificially boosted UiPath's growth metrics. But management firmly and categorically debunked that rumor on the call.
The CFO stated explicitly that the $25 million figure is wildly inaccurate. From a financial perspective, the acquisition is actually below their materiality threshold.
So they did not buy WorkFusion to artificially inflate their top-line revenue. They bought it strictly for the intellectual property.
A pure technology tuck-in. What does WorkFusion actually bring to the table?
Deep, purpose-built AI agents specifically trained for financial crime compliance. We're talking about anti-money laundering, AML, and know your customer KYC capabilities.
Explain the mechanics of KYC and AML and why an AI agent is so valuable there. Because these aren't simple data entry tasks, right? They're high-stakes investigations.
Right. In banking, KYC and AML compliance require armies of human analysts. When a new entity tries to open an account, a human has to manually check international sanction lists.
Verify passport data, dig through complex corporate structures to find the ultimate beneficial owners.
And scour news articles for adverse media regarding the individual. It is painstakingly slow and prone to human error.
And the regulatory fines for missing a money launderer are in the billions.
Exactly. So WorkFusion built AI agents that automate this entire investigative process. The agents autonomously pull the data from the databases, read the adverse media, cross-reference the sanction lists, and present a fully summarized dossier to a human compliance officer for final review.
And it leaves a perfect audit trail for the regulators.
Yep. By acquiring this, UiPath gains immediate credibility and ready-to-deploy technology in the highly regulated financial services vertical.
And they're executing a very similar vertical push in the healthcare sector. They launched agentic solutions tailored for healthcare administration.
Tackling massive friction points like revenue cycle management, medical record summarization, and claim denial resolution.
And prior authorization, right. That's a perfect example. A doctor prescribes a treatment, and a human at the hospital has to manually compile the patient's medical history, format it to the specific insurance company's requirements, submit it, and wait.
And if they miss one code, the claim is denied.
Right. By building specific AI agents trained on medical coding to handle this, UiPath transitions from selling a generic tool to selling a guaranteed outcome. They aren't selling software, they are selling a 50% reduction in claim denials.
But they realize they can't scale this outcome-based selling motion alone. Building custom solutions for every hospital and bank requires massive consulting resources.
Which brings us to their ecosystem strategy.
Yeah.
Their partnerships are driving massive scale, particularly with the large global systems integrators.
Yeah, they highlighted a massive expansion with Deloitte. Deloitte partnered with them to launch a practice called agentic ERP, embedding UiPath's AI agents directly into mission-critical finance workflows.
They detailed a case study of a Fortune 20 oil and gas company undergoing a massive migration to SAP S/4HANA.
For context, migrating an ERP for a Fortune 20 global conglomerate is basically the ultimate nightmare of IT complexity.
It takes years, costs hundreds of millions of dollars, and the risk of business disruption is massive.
Because every single process, supply chain, payroll, inventory runs through that ERP. If it breaks during migration, the company halts.
And Deloitte is using UiPath's platform, specifically the Test Cloud product, to manage this monumental migration. The AI agents are autonomously mapping the old processes and testing them in the new environment.
Deloitte expanded the automated test coverage from a mere 10% to roughly 50% of the entire SAP environment. drastically reducing the risk.
And Accenture is another massive partner. They deployed a global agentic sales order entry solution for a life sciences customer. This solution orchestrated autonomous agents to navigate an incredible 150,000 different system exceptions.
And it reduced the overall processing time by a third.
When Accenture and Deloitte are building multi-million-dollar transformation practices centered entirely around your platform, it creates an incredibly sticky ecosystem. The switching costs become practically insurmountable.
So we've established the product works, the ROI is proven, the vertical use cases are expanding, and the biggest consulting firms are selling it. We inevitably arrive back at this central paradox. Why the cautious 9% forward guidance?
We have to look at the macroeconomic and federal spending backdrop to understand management's prudence. On the call, the CFO used a very specific word to describe the current macro environment. Variable.
Variable. The classic CFO euphemism for we do not have perfect visibility into our pipeline and budget cycles could freeze abruptly.
Precisely. They noted pockets of strength in specific verticals like financial services, but they highlighted persistent uncertainty stemming from geopolitical conflicts and inflation.
CIOs are scrutinizing every single dollar right now.
However, there was a very interesting nuance regarding the public sector, specifically the federal government. A year ago, there was tremendous weakness there. Budget continuing resolutions stalled procurement.
But on this call, the CFO noted they are seeing really good traction in the federal space. Management specifically mentioned the Department of Defense is showing an increased appetite for long-term strategic automation projects.
That feels like a massive positive reversal.
It is. The DoD is not a fast-moving buyer, but when they commit to a platform, the contracts are massive and durable.
But despite that traction, management still baked heavy prudence into their forward guidance. They use sophisticated, AI-driven forecasting models that triangulate pipeline data, and those models are telling them to remain conservative.
Furthermore, there is a structural accounting headwind they explicitly quantified that is artificially depressing the revenue growth rate.
Right, let's explain this headwind because it's crucial. The CFO noted that as customers adopt an AI-first operating model, they are accelerating their migration to UiPath's cloud offerings. They ended the year with over $1.2 billion in cloud ARR, up over 20% year over year.
On the surface, massive cloud adoption is the holy grail for a software company. Why is it creating a headwind?
It all comes down to the mechanics of ASC 606 revenue recognition rules.
Oh, accounting rules. Always fun.
Right, when UiPath sells a traditional on-premise term license, they are allowed to recognize a large chunk of that revenue up front the moment the software is delivered.
Okay.
But when a customer shifts to a software as a service or a SaaS cloud model, the accounting rules dictate that the revenue must be recognized ratably spread evenly over the life of the contract.
So if a massive customer transitions from on-prem to the cloud, the total contract value might increase and the ARR increases, but the immediate recognized top-line revenue drops significantly in that first year.
Exactly. The CFO explicitly stated that this ongoing shift to SaaS offerings will create a 1% headwind to total revenue growth in fiscal 27. The underlying business is growing faster than the recognized revenue suggests.
We have laid out all the facts, the top and bottom line beats, the margin expansion, the AI adoption metrics, the ecosystem, the macro prudence. Now it's time to figure out what the market is actually thinking.
Because Wall Street's synthesis of this data has resulted in material, painful sector underperformance.
The relative performance of the stock is stark. If you look at the total return over the last quarter from mid-December to the day after this print, the stock is down 34.7%.
Wow. And compare that to the IGV, which is the benchmark ETF for the broader software sector. The IGV is down 21.3% over that exact same period.
The entire software sector is facing a cyclical drawdown, but UiPath has materially lagged the benchmark by over 1,300 basis points in just 3 months.
And the sell-side analyst reaction immediately following the earnings print illustrates exactly why. It was a bloodbath of price target cuts.
UBS cut to $13, Morgan Stanley slashed their target to $17, Mizuho cut to $12, Wells Fargo and D.A. Davidson both cut to $13.
The consensus was incredibly uniform and incredibly cautious.
To synthesize the core problem the analysts are struggling with, we have to look very closely at one specific metric, DBNRR, or dollar-based net retention rate.
This is arguably the most important metric for a mature SaaS company, right? It measures how much your existing cohort of customers is expanding their spend with you year over year.
Net of any churn or downgrades. The numbers show UiPath's DBNRR sitting at 107%. If you adjust for foreign exchange, it's actually at 106%.
Now, for someone outside the enterprise software bubble, 106% sounds positive. Your existing customers are staying and spending 6% more. Why is that triggering downgrades?
It is entirely a problem of expectations relative to the peer group. Top-tier compounders regularly post DBNRR numbers of 115, 120, even 130%.
Ah, got it.
When your DBNRR drifts down to 106%, it signals to the market that while you aren't losing customers, their gross retention is best in class at 97%. Your ability to rapidly upsell them on new products is severely constrained.
Taking that a step further, it brings us right back to the massive gap between the narrative and the math. There's a canyon between the narrative of AI hyper-adoption and the reality of a 106% net retention rate.
Exactly.
Wow.
The analysts are doing the math. If 60% of your top customer cohort is buying AI products and spending 3 times more, but your overall net retention rate is only dragging along at 106%, what does that imply?
It implies that the non-AI portion of the business, the legacy RPA base, must be experiencing significant deceleration, seat count reductions, or severe pricing pressure to drag the overall average down so heavily.
Investors are treating this company as a maturing legacy automation vendor that's successfully protecting its turf and harvesting cash, rather than a renewed software compounder riding the AI wave back to 30% hypergrowth.
So if you are an investor trapped in this narrative, what actually changes the sentiment? What are the key catalysts you need to watch over the next 6 months?
The first immediate catalyst is the upcoming Agentic AI Summit, scheduled for March 25th. Management is going to heavily showcase the new coding agents. The market will be watching to see if these tools have clear, immediate monetization paths that can re-accelerate the pipeline.
Second, the street needs to see hard evidence that the WorkFusion acquisition is actually leading to material cross-selling in the financial vertical.
And finally, and most importantly, they need to see explicit signs of ARR re-acceleration in the Q1 and Q2 checkpoints. If ARR growth ticks back up toward the mid-teens, the valuation multiple will expand rapidly.
If it stays at 9%, the stock will remain heavily range-bound, tethered entirely to its cash flow yield.
This has been an incredibly deep and nuanced breakdown, but now it's time to transition into our not financial advice segment.
Yes, I need to be explicitly clear here. Talk Tickers does not provide financial advice. This segment is purely an intellectual exercise in financial mechanics. Think of this scenario like a couple of analysts at a hedge fund pitching a wild, contrarian, but mathematically sound trade idea to their investment committee.
Based entirely on the extreme disconnect between the pristine balance sheet and the collapsed stock price, I'm going to pitch an option strategy I call the M&A floor agentic call spread.
Set up the fundamental premise for the committee. Why are we looking at options here instead of just buying the equity?
Here is the structural setup. We have a stock sitting at $11.37, battered by a cautious growth guide. But let's look at the underlying asset. They have zero debt, $1.67 billion in cash and marketable securities. They authorized a fresh $500 million buyback. They throw off $182 million in adjusted free cash flow this quarter alone.
When you factor in the $1.67 billion in cash against the current market cap, the actual enterprise value of the operating business is incredibly low.
Precisely. And that dynamic leads to the core thesis. Private equity firms like Thoma Bravo or massive tech incumbents like Microsoft or ServiceNow are absolutely drooling over these exact financial metrics.
They look at the 30% margin trajectory and the fortress balance sheet, and that sticky 97% gross retention.
Right. Once UiPath is wired into an ERP system, it doesn't get ripped out. If the public markets refuse to assign a reasonable valuation multiple to a debt-free software company generating hundreds of millions in free cash flow, an acquirer absolutely will.
That creates a massive structural mergers and acquisitions floor under the stock price. The downside risk is heavily protected by the pure cash generation and the high probability of buyout if the stock drifts lower.
And we already have empirical market signals confirming that massive players are positioning for exactly this kind of structural floor.
The bizarre options activity we discussed at the very beginning.
Yes. The 0.40 put-to-call volume ratio on a day the equity dropped 8% is the absolute tell. Someone is already betting heavily on a massive upside surprise, positioning for either an M&A event or a fundamental reacceleration.
Let's walk through the actual trade mechanics for the committee. How do we execute the M&A floor agentic call spread?
Step 1. You sell near-term, out-of-the-money puts. Look at the put options expiring in 30 or 45 days with a strike price of $10. Because the stock just dropped 8% on massive volume, the implied volatility for of those options is through the roof.
The market is terrified the stock is going to zero, which means those puts are incredibly expensive.
By selling those puts, you're acting like the insurance company. You collect a rich cash premium upfront in exchange for agreeing to buy the stock at $10 if it drops that low by expiration.
And given the cash pile and the buyback support, $10 is a price you would happily own the entire company at anyway. The fundamental floor protects you.
Exactly. Step 2. You take that cash premium you just generated and you use it to finance the purchase of long-dated, deep out-of-the-money calls. Go look at the options chain 6 to 9 months out, maybe strike prices around $15 or $16.
What is the specific strategic rationale for structuring the trade this way? Why not just buy the stock?
It is about supreme capital efficiency and risk mitigation. You're basically getting paid by the panicked market to wait out the variable macro environment the CFO warned about. If the stock just chops around sideways between $11 and $13, those $10 puts expire worthless. You keep the premium, and your long calls cost you effectively nothing.
But consider the upside scenarios. If a private equity buyout gets announced at a standard 30% premium, or if the new coding agents drastically pull forward revenue and ARR growth reaccelerates, the stock is going to gap up violently.
And when it gaps up, those cheap, long-dated $15 calls you financed for free will print massive leveraged returns. You have structurally captured downside due to the fundamental M&A floor, and you have highly leveraged upside if the AI narrative clicks.
That is a phenomenal, highly logical pitch. You sell the market's irrational fear to fund a leveraged bet on the underlying cash flow. I love the architecture of it. But again, to everyone listening, that is an intellectual exercise, not a recommendation for your personal portfolio.
Absolutely. The mechanics of options trading carry significant risk. The pitch just highlights how structural market inefficiencies create massive opportunities when you dig deep into the unit economics.
And dig deep we certainly did today. Let's recap the primary tension we've unpacked. The story of UiPath right now is a fascinating push and pull. On one side, pristine, historic bottom line execution. A fortress balance sheet, a march toward 30% operating margins.
On the other side, a forward top-line growth rate of 9% that simply isn't satisfying Wall Street's voracious appetite for AI hypergrowth.
The definitive question going forward is whether their new agentic automation products can spark a second wave of hypergrowth, or if they settle into being a highly lucrative but slower growing value play.
As you watch this stock over the next 2 quarters, keep your eyes heavily fixed on those Q1 checkpoints.
Watch the mechanics of the cloud mix transition. Look for any acceleration in the AI product ARR cohort, and monitor the large deal momentum coming out of the federal defense space. And always keep an eye on the options flow. Sometimes the derivatives market is quietly telling the exact story the equity market is trying to ignore.
I want to deliver our final disclaimers. This entire deep dive was an analysis of publicly available earnings data and market reactions. It is not an endorsement to buy or sell securities. Always do your own rigorous due diligence.
Thank you for joining us. We will leave you with this one thought to mull over. If an AI agent can flawlessly build an enterprise automation in 10 minutes that saves a telecommunications company $20 million, how long until that same AI agent figures out how to optimally allocate capital and buy its own company's stock? Until next time, we are Talk Tickers.